Welcome, 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 everybody. I see you're all starting to filter in. I'd like to welcome you all to Office Hours by Alternative Payments. While you all are filtering in, I am going to launch a poll. The poll answers are, I believe they're anonymous. We're not adding your answers to some secret database or anything. We just like to know who we're helping, so that way we can tailor these office hours events to our audience. So if you could take a moment to answer these poll questions, that would really help us. I promise we're not going to add you to a sales funnel unless you say, please contact me. We're going to leave you be. Okay. So yeah, please just take a moment, fill that poll out. While we do that, I'm going to let you know about a couple of other things we got going on. I'll have one more poll in the middle of the event. And then at the end of the event, when you leave, there's going to be an anonymous 2-question survey to gauge how you liked the content and what we can do better next time. So with that said, while you guys keep filtering in and doing that poll, I would love to introduce you to our panel. First, we have Baxter Lanius, CEO of Alternative Payments. Baxter has a background in finance and M&A. He is a wealth of knowledge, so please take advantage of that knowledge. Ask your finance and M&A questions. Next, we have Paul McCann, founder and CEO of Red Earth CPA, and they are an accounting firm that specializes in supporting MSPs all around the US. So again, wealth of knowledge all around accounting and taxes. So please pop your questions in the Q&A as we're going through this, and I will make sure the appropriate person can answer that. It's December 5th. Some of you guys are probably swamped with project work, and others are already checked out with Christmas music playing in that little jukebox in the back of your head. Just me? Okay. However, Paul put together an amazing presentation on tax planning. I know that sounds really weird to say, but we got to look at the slide deck. We worked together to, put together an agenda that we really think is going to help you guys out. And I'm excited for this one. And I think Paul and Baxter are excited for this one as well. I'm going to do my best to keep this light and entertaining. Paul and Baxter are going to do their best to keep it highly educational. So Paul, how can we get Baxter to buy me an Apple Vision Pro now that it's the end of the year?
Oh, that's an easy one. Well, you gotta put the expense report together and then set it in.
Okay.
Approve.
Yeah, exactly.
All right. Paul, please feel free to dive right in, man.
Well, thank you first of all for having me back. I hope it's amazing and exciting, but I will settle for engaging. And if you stay awake, that's a win. So I'm happy with that. Thank you to Baxter, to Steve, having me back, and want to kind of distill some nuggets. We're at the end of the year. We want to figure out, we have 26 days left in the year. If you're a cash basis taxpayer, which many small businesses are, most small businesses are, then you have 26 days to make tax-related transactions that impact how much you pay on April 15th or before. So that's the spirit of what we're looking at. And also, I think, we've talked about this a little bit, but 7 Habits of Highly Effective People is Stephen Covey talks about staying within your circle of control. And there's a circle of awareness, and there's a lot of things, certainly in an election year, there are a lot of things that are outside of our control. Taxes, one of the reasons I like tax planning or thinking about and talking about this right now at this time of the year is it is within your circle of control. But in 27 days, it's not in your circle of control for many things. So for 26 days, we have relevant ideas of things that you can do, of steps that you can take. So I've put a few things together for everyone and want to I want to go through that with you guys. I threw a disclaimer in there. This is the same old stuff. I'm not giving specific tax advice, so I put this in there. We were discussing this, and this is a I only have a few steps on what I'm saying. It's very high level. I'm not going to get into the weeds on certain strategies and talk about all these. I'm really talking about your business income as your MSP, and I'm talking about a tax credit and then some other additional details. But when you're looking at, most people on this call are business owners, and many, if not most, high percentage are also taxed in a pass-through entity. A pass-through entity would be an S corp or a partnership. Many small businesses are taxed that way. So the impact of that, as many on the call are very aware, that is, if your business has a good year, you get to pay the taxes on it, and it flows into your personal tax return. It doesn't, the business doesn't write a check, for the most part, to the government for the income taxes that the business owes. It comes to your personal return. So what I'm saying is that there's a connection between what your business does and how much income your business reports and how much you have to pay in April. So the first step to managing your business is managing your personal taxes is to manage your business income. And that is very, very simple. That if we can manage what we have at the business entity, we're going to manage what we have on the personal tax side of things. So this is I threw a few things on here, and let me define my term here. Deferred revenue is used all the time in MSPs. This is set up when you work in, if you integrate your PSA into your accounting file, your PSA integrator will talk about deferred revenue. Deferred revenue means your company, somebody has paid you for services that you haven't performed yet. And you're like, okay, prepayment, that's a common way people call it. This can be problematic. I'll talk about that in a second. There's also prepaid expenses. What does this mean? If you can manage what, let me back up here. Most people are on an S corporation, which is and file taxes on a cash basis. So the industry, however, in the MSP industry, if you're benchmarking, if you're with True Methods, or if you're in Evolve, if you're doing some kind of industry benchmark, you want to know your profitability based on your accrual income or your book income. The difference is you file taxes on the cash basis, but you use the accrual basis for all of your internal management reports. This is kind of the challenge. This is a big opportunity for a mistake. And what do I mean by that? I mean that deferred revenue, while it's used all the time, is taxable on the cash basis, but it's not included in income if you're on the accrual basis. So if you have a big prepaid revenue that people have given you money, that on the cash basis is taxable. And that's something I see people get caught up on quite a bit.
Well, and ultimately, Paul, right? Like the complexity from a tax perspective and the gamesmanship that people are able to play from a tax perspective basically is nearly all about this, which is when do you account for revenue coming in the door, and when do you account for expenses going out the door? And is it money coming in the door, or is it an invoice coming in the door, or is it money going out the door? I was talking to our team yesterday, and I was giving them this example, which is I can, as a business owner, I can create an invoice for $100 million. I can book that $100 million as revenue, and show that on my income statement as a $100 million revenue business. So we don't use PSA software at Alternative Payments, but let's say I did, and I create an invoice for $100 million, and all of a sudden the business does $100 million in revenue. Like,
Amazing.
that's amazing. That's incredible. You know, we're a unicorn, guys. Like, let's fucking go. But it all has to do with the cash versus accrual basis, and that's obviously not cash that's coming in the door. Which is clearly obviously the difference between, you know, all these items on deferred versus prepaid expenses.
Yeah, I think good point, Baxter, because I think what you're saying is we're also not talking about GAAP accounting. So we're not talking about, well, it's a, we book this income and we're not worried about publicly traded companies here. We're talking about cash in and cash out, because that's how most people are paying their taxes. If you've received the cash, it comes in to hits your bank account, or it's in your possession and are constructively received, is the phrase, then it's taxable. And if you send the check, then you get to expense it. That is in contrast to what Baxter, your illustration of just sending an invoice. I mean, that's so these are, as you mentioned, Baxter, these are the games that we can play. So if you manage, so I just wanted to kind of camp out on this first one, because if we if we spend time thinking about that, and that's what I really wanted to do, like, let's just think about where our taxes are and what we can do right now on December 5th to minimize our taxes. And most bang for the buck is going to be at the business level of being able to manage how much we want to pay in taxes, essentially, because it is within our circle of control. So there's deferred revenue on their books. That's money that you've received, and that will be taxable if you're on the cash basis. But you can also prepay expenses and marketing expenses, professional fees. If you have money sitting around in the account, you got a good year and cash is in the bank, you can call up your vendors and say, hey, I'd like to pay for this service. And that, on the cash basis, you can deduct those if it's within the next 12 months for many expenses.
And the other thing that I think is important to hone in here, Paul, is the reason why the business income is more important is because for the majority of MSPs and the majority of business owners, the majority of your income and the majority of your net worth is going to come from your business.
100%.
So the reason why the business is most important to deal with first is because everything then is implied based on your business's success, assuming, again, that 100% or 50% or 60% of your net worth, both on the income basis and valuation perspective, is based on that business's success.
Yep. Yes. And so you can also delay sending out invoices. I put a case study together. This is just a very quick example. I was recently talking with someone, and this situation is not exactly where they're at, but this is close enough. It's an S corporation. S corporation means that they are reporting for their management purposes, they are reporting on the accrual basis, but on the tax purposes, they are paying on the cash basis. So there's a distinction. Let's say $300,000 expected net income. So we counted up their expected billings and receipts and the expenses for the rest of the year. And we said, hey, it's going to be $300,000 by the end of this year if we don't do anything else. The deferred revenue on the books is $50,000. So they have customer prepayments of $50,000. And their monthly managed revenue is recurring. And so it's pulled. It comes in automatically through their process, the AR process. And they have an additional project invoice where they have completed everything in a project. They've even purchased the hardware for the client and sent them the hardware, and they have $100,000 invoice to send. And that's really when we were sitting around talking about it, I said, well, what is it? Where are we at? And they said, well, we also have this project that we've completed. And they're saying, well, what is it? And if they send that invoice if they send the invoice and the customer pays, well, they have an extra $100,000 of income in the next 26 days that they will all of a sudden need to pay out in taxes next year because of that transfer was made before the end of the year. So I think really, and also the other thing here is they have a deferred revenue. So not only do they have the $300,000 of net income, but on the cash basis, you have to add in that deferred revenue. So that's what I don't want people to forget about that. That's my point with that. So they don't just have 300, they have 350 if you add in the deferred revenue. And then if you add in the 100, if they bill it, so if they bill this on December, let's say they do it on the 23rd, they send on the 23rd and the client's a net 7, and they pull it, they bill the project income and the client pays it, and they say, oh, I have an opportunity to reduce my taxes. They send $100,000 in on 12/30. Now all of a sudden this client has $450,000. So the challenge here is how do you manage the income? And I think this client would love to send the invoice on 12/31 and get paid after the first part of the year. So that's one of the things that they walked away with. But I think my takeaway here, if I could leave you a takeaway, think about where you're going to be, count up where you're going to end up, begin with the end in mind, and then figure out, are you comfortable with that? Do you know what the taxes would be on that? And do you want to mitigate that in any way?
Hey, so someone asked a question that I feel like it's as simple as checking a box. How can you tell if you're paying taxes on a cash or accrual basis?
That is a great question. That is a great question. If your company's filing an 1120S, you can go to page 2, and on page 2 of the 1120S at the top, there's a little checkbox and it says accrual or cash. So it's on your tax return. Open it up, take a look at the second page of 1120S, and it's right there. I think it's section B if I'm not.
And then do you have, like, say I filed accrual last year, do I have to file accrual this year, or can I switch back and forth?
The right answer is no, you can't switch back. The technical answer is you could, but it's very painful and you don't want to do it.
Okay. So that's something to keep in mind then is, picking the one that you're going to go. And obviously if you've got a lot of deferred revenue every year, like Brad said, 3 customers were like, hey, I can pay you for the next 3 months for our taxes. And he's like, what about my taxes? So if you get a bunch of deferred revenue at the end of every single year, it might not be a bad idea to be filing accrual, unless there are other caveats that I'm not thinking about here.
Well,
and I know we're getting in the weeds.
Yeah.
Now, so
I most of the time cash basis is preferred simply because people don't want to pay taxes on money they haven't received.
Gotcha.
That's primarily, and it's, if you're having trouble with your accountants right now, switching to accrual will mean twice as much work. So those are just some things to keep in mind. But if you're using a software like Xero and it automatically puts you on accrual, that doesn't mean you registered accrual with the IRS. So I'm talking primarily to English, American taxpayers here. So if you're using Xero, it automatically comes as accrual. I think sometimes QBO does as well. That doesn't mean you file that way. You don't have to file that way. You can make a choice to do that. But once you make that choice, you got to file that way each year, or you have to make a special election and go through a bunch of hoops, and it's a pain.
Paul, what percentage of businesses file accrual versus cash? I mean, my understanding is it's like 90% cash, but
yeah, I'd love to know that. My experience is almost everything's cash.
Yeah.
Until you're larger. Like it used to be, Tax Cuts and Jobs Act, it used to be, they moved the numbers. I think you can go $20 million in revenue and still be on the cash basis. So they bumped it up significantly. Now, most of the time you get to that level and your VCs are going to want accrual basis. And I mean, all your benchmarking wants that anyway.
Yeah. Yeah. I mean, I think I think for, most businesses should be accounting on an accrual basis and then paying taxes on a cash basis. Obviously, there's always edge cases and always companies that fit outside the box, but certainly the accounting on an accrual basis is super important.
And that's an industry standard. I mean, that is when I started serving MSPs, like That is, everybody is hook, line, and sinker in that methodology, which is the correct way. But I want to say that when you do that, you have these little things. If you have a prepaid expense on the accrual, you have to back that off, or a deferred revenue. You have to back that off for tax purposes, and it can catch you by surprise.
And then we have, oh, go ahead, Baxter.
No, I was going to ask this question, which I think is a really good question that Mark just
asked. Yeah. So before we go to Mark's question, I want to go to Matt's question. He asked, in QBO, can you change for accrual to cash? Now, with QBO, we're talking about the accounting side of things, not the tax side of things. So I think the answer, correct me if I'm wrong, Paul, the answer is yes, you could change from accrual to cash. I think the better thing to say, though, is why would you want to? Because as we've already alluded, most MSPs in your tax bracket are accounting in accrual and paying taxes in cash, and you can see what cash you haven't collected by looking at, for example, your AR report. And I'm sure there are some other reports that you can either look at pre-existing reports, or you can get creative and make your own reports to help you understand how your cash flow and cash reserves and all that stuff are looking, even though you're accounting on an accrual basis. Am I correct with that, Paul?
Yeah, you are. You can do that. You can make a setting. Great point, though, Steve. Just because you change it in QuickBooks doesn't necessarily impact your taxes, and vice versa. And also, you go up to the gear icon on top right and go to accounts and setting, and then you can change it from cash to accrual. But you can do it a lot easier if you just pull the report in QBO, go to reports, and there is a cash and accrual, and you toggle the button, refresh the report, and it will. Now, I will say that's that's really kind of like remedial accrual. It doesn't really get down to if you're going to go be technical about it, you're supposed to accrue wages, you're supposed to account for prepaid expenses and all the other things. It's kind of like just dealing with the bills and invoices.
Yeah. And obviously the best thing we can tell you is, talk to your accountant or tax advisor that you work with locally. If you don't have one, we know a guy. Mark had a great question here. He says, what challenges have you seen with MSPs that are franchises where the national franchise organization requires you to pay their franchise fees on an accrual basis, but your accountant is managing your taxes on a cash basis?
Well, not just that, but you can throw in sales tax.
Before you jump in, Paul, I think the other thing that's interesting about this question is Mark's asking it in relation to the franchise dynamic, but this is a dynamic of all businesses at the end of the day. Right. I mean, obviously there are franchise fees attached to it, but everybody has this challenge around accrual versus cash, how to manage it accordingly. Sorry, I just wanted to.
No, that's exactly what I was going to say, Baxter. I wasn't going to limit it to a franchise. If you're doing sales tax, there are states that require you to report an accrual, and maybe you're paying it maybe you report on your income taxes on the cash basis, but your state requires you to pay sales tax on accrual. And then you have these really ugly negative balances on the cash basis on your balance sheet, and it drives your accountant nuts. And that's part of it, though.
But sorry, just to hone in on that question. I mean, the challenge ultimately is around deferred revenue and prepaid expenses.
Yes. So it just makes sure that you know what your taxable number is going to be, even though you have a few things on your balance sheet. Look, your accountant, reach out. It's a 5-minute call. If they're in your books, they will be able to tell you at least this. It's a little bit longer to figure out what your income is going to be at the end of the year, but it's, like I said, 26 days, you can do something about it. And then Baxter, I mean, you and I have talked, Steve, we've talked about, moving accounting from your prefrontal cortex so you don't have an amygdala hijacking. Taxes are a lot of that. So if we can move it out of that side of your brain so that at April 15th, you know exactly, I mean, what I want my clients to know exactly how much money they're going to have to pay in April every year. So they're not ever they're not ever surprised by it.
But, and then the other dynamic, which I think is interesting with franchise businesses, is you're most likely paying a franchise fee tied to gross revenue and not necessarily profitability.
Right.
So if you would actually rather have a lot of deferred revenue and all your customers are paying you cash up front, but you're then paying the franchise on a lower revenue number over time. So like to play the game.
I can hear the gamesmanship.
If you want to play the game, which happy, Mark, to connect with you later.
It sounds like due diligence, Baxter.
You would want all your customers to pay you, upfront on an annual contract if you can. So for 12 months, and then, I don't know how your franchise structure is based, but you would then pay monthly franchise revenue fees to whoever it is, because then you can use that upfront cash to invest in the business for all different reasons. Now, there could also be a marketing expense fee tied to it. There may be a profitability component, but I haven't typically seen that with franchise businesses. So, that's a little bit more detail, but happy to connect offline, or connect with Paul directly, because I'm not a certified accountant. I'm an accountant in training, and Paul trains me every week.
Oh, what are you talking about?
Every week
you sat through all those due diligence. I know your timing. I mean, yeah. Is it the second component? So I really only have a few things. The first one was just managing your business, timing your revenue and expenses, and you have control to be able to do that. This is a little longer. I get this question quite a bit from MSPs because they've heard about the R&D tax credit. So I just threw it in here. I thought let's talk about it. This is not a deep dive into it. Steve, have you ever run across the R&D tax credit?
Well, I have not tried to use the R&D tax credit. I have a buddy who I will not name, and I swear it's not me, who he decided to buy like Nintendo Switch and some video game systems, and he told his accountant that he was doing R&D to determine if he was able to provide tech support on those devices. So what I was thinking is maybe we can get some Apple Vision Pros, and because what I'm thinking is I want to start doing these webinars in the metaverse or whatever. Yeah, so we can use AI Steve, and then maybe that Steve, his neck will turn.
So, well, you're in a business where ordinary necessary does cover a lot of tech toys. I do run into this, and I just put this on there because I ask clients, prospects that come in, have you ever filed for an R&D tax credit? And had a conversation this past week with somebody new, just trying to get to know their business. There's 4 components of it. This is very high level: technical uncertainty, process of experimentation, technological in nature, and qualified purpose. So most of the time, MSPs have something that qualifies because computer science as a segment is specifically called out by the R&D tax credit. So the government wants to give you a discount on your taxes just for doing some things that you already are doing. And that's why I bring this up. Is this a cure-all that you're going to get done in the next 26 days that are going to impact your taxes? No, but you could get a study that could also impact it for up to 5 years in the future as well. This is really an awareness, guys. That's really what I want to bring awareness to. There are things, you can read the slide here, but these are some common activities that people are doing. And some of them, I know that you're looking at this and saying, I'm already doing that anyway. Yeah, that's what I'm saying. You probably are doing this. Now, they are, again, the states have R&D tax credits. The IRS has R&D tax credits. It is a reduction in taxes based on the money you're spending. Most likely, you're already doing that right now. I mean, improving processes or the manufacturability of a product. Well, if you're doing that right now, you can get some credits on that. But how much, right? Show me the money. How much can I possibly get? Now this is why I put a disclaimer on the front, guys. I mean, it is all over the place, but I have seen some absolutely amazing numbers that I just want to make sure that I'm at least mentioning this as a tax strategy to a bunch of MSPs. California has a 15% state tax credit. QRE is qualifying research expenses. There's a few different words phrases they use, but you're looking, I mean, if you're spending $500,000 and that may or may not be a lot of money, but you're looking at $100,000 of tax savings. Reminder, tax credit is not the same as a deduction. A deduction is kind of like an expense. A tax credit means a dollar for dollar on the amount of taxes that you would be paying.
Yeah, I don't get it.
Okay. I think there are a lot of good use cases if and when MSPs are developing software technology really innovating.
I think you're right. I think Baxter, I mean, this goes back to, is there a process of experimentation? And that's kind of the litmus test. It's worth throwing it out there because I hear this question quite a bit. Does it really qualify? What I do is I partner with a reputable, and I use that word, accentuate that word, reputable tax credit organization that will do good research and look for these expenses. That's what I do. I'd be happy to send people to make an introduction or send people along to that. All right, so we've done managing your business. I threw in a few other things that I just wanted to spend a little bit of time talking about. Some of the errors, I don't know if I want to call them errors, but maybe sand trap that business owners run into.
Limited gamesmanship.
Okay, I like that. That's good. If you are running an S corporation and you are paying yourself your wage, you have to be on the payroll as an owner, and that money is then your salary is subject to payroll taxes. So this payroll tax rate is just FICA. Once you get to $168,600, above that amount, only Medicare is in at 1.45%. So you lose most of this. This is not income tax. So if we're not talking about income tax, we're talking about payroll taxes here. The amazing thing about running an S corporation is that if you reduce your own wages, you pay less in payroll taxes. Now, I know most of you guys understand this, but I'm talking just to a few people who may not have thought about this. I ran into somebody recently and they were looking at giving themselves a bonus at the end of the year as an S corporation. So as an S corporation, you don't want to pay yourself a lot of money. The goal is to pay yourself little money. I've run into, and why is that? Because if you were to take a distribution, and a distribution is a fancy way of saying a dividend, but you were to take money from the company and you were to transfer it into your personal checking account, there are no payroll taxes on that. The rate is zero, the amount is zero, and if you increase the amount of money, there's something in the Tax Cuts and Jobs Act, basically 20% of your profits you get to take as an expense. So if, however, you take a bonus, you're going to pay 15.3, that same exact amount of money, you're going to pay $7,600 on that. And you're going to lose out on that 20% of the amount, which will then come through as that it increases your taxes. So your adjusted gross income, what you end up paying taxes on a personal, personal amount will be much, it's just a whole lot higher. So the game here is and talk to your tax advisor, just set it up. Anything below that amount, if you modify your salary, so if you were to take $50,000 less, if you're paying yourself $160,000 this year, and you said, I'm going to drop it down to $110,000 in 2025, you're going to save yourself $7,650. right off the top in payroll taxes that you personally or your business pays. That's a big ROI. And you're like, oh, well, Paul, you can't really do that because it has to be reasonable. There is also this is where I go back and I talk about there's a balance between, anyway, talk to your tax advisor about that. This is if you haven't thought a lot about your owner compensation, as an owner, paying yourself a high wage is not the way you want to do it. You want to pull it out as a distribution. I just want to say that.
So how I've been told that you have to pay yourself a reasonable salary, but I think reasonable is objective or subjective. I never really know the right way to use it. Andy says, how little can we pay ourselves as an owner? We've been told 150,000 will not cause flags with the IRS. I've been told that the amount you pay yourself is obviously dependent on how much is available to pay yourself. But, here in Northeast Ohio, you could get away with paying yourself between $40,000 and $60,000 a year.
Well, your mileage may vary on this one. This is, again, the disclaimer. Reasonable is highly subjective. Steve, to your point, if you're in an S corporation, the IRS will sue people for having your compensation too low. However, if you were a C corporation, for example, the IRS will sue you if they think your compensation is too high. So what? Yeah, no, I'm serious. And so what tax people do is they go to the court cases for the IRS against C corporations and take those arguments and they put them against the S corporation and vice versa. So all that to say, it varies based on how much money you're pulling out of the company. But what I would recommend, Service Leadership puts together every year, and unfortunately it was November 30th. If you contribute to their compensation report, they give you a free copy of it. And this really levels the playing field as far as what the compensation is for the market. It has a lot of different factors, but that's a market rate. That's not reasonable. What I say, and I'm not going to, it's a rule of thumb that people don't like to say out loud. I go ahead and tell. I say basically a third of how much money you pull out of the company is in wages. So if you're pulling out $450,000, $300,000 distribution, $150,000 in wages, then that's right on. Your wages is 33% of your total amount that you're pulling out.
And I think all of that is enough for you to have a one-bedroom apartment in San Francisco. So, you're probably right on track there.
Well, I have no idea about that. So not in that much. But
I've heard
that's
things.
A rule of thumb. People really don't like to be pinned down on that one. I have talked to a lot of clients that have come from different accountants. They have a lot of different ideas on that one. Talk to them about reason. Like there's a difference between market-based compensation and reasonable compensation. The purpose of this slide is just to say, don't give yourself a big bonus when you have the opportunity to take a distribution.
Sure. Now, should you never give yourself a bonus? Should it always be a distribution?
Well,
we're getting in the weeds again, aren't we?
Well, I would rather take a distribution personally. I don't think I'd ever bonus myself because you're going to have withholdings at 21% right there off the top. That's going to go to the federal government and you're going to pay payroll taxes on that. If you want to do that, it's okay. I think there's a reason you would want to do that. And if you're trying to increase your wages at the end of the year for some reason. Now, I do have to say there's a caveat here. If you're concerned about your future Social Security benefits, then you want to pay yourself. The more you pay yourself on your wages, the more you receive in future compensation. And as a guy who's my brother-in-law passed away at age 32, and my nieces are on Social Security disability or survivor benefits, that hits home for me. The amount that he paid into Social Security it does have an impact. So I don't like to think about those things, but I do think that I should at least disclaim that the payroll impacts that.
Yeah, but I mean,
That's really
generally, right, you want to avoid double taxation at all
Right.
costs. And the bonus structure is just double taxation because you're being
Totally.
taxed at the corporate level and you're taxed at the personal level. Whereas the distribution strategy on the left allows you to just be taxed at the personal level. And so that's ultimately the play here.
Yeah.
that makes perfect sense. There are a few questions I'd love to tackle real quick. Two of them are on R&D. Andy said that the R&D firms he's talked to has wanted 1% of the credit in cash. I'd rather pay the professional for the time spent. Can you offer a referral to a company that specializes on this for MSPs?
No, I can't, because they
Okay.
all do that. They either have a flat
Okay.
fee or they will charge a little bit more when you get the credit. That's another strategy I've seen.
Yeah,
But
I
no,
think
I don't know anybody. You might talk to your tax preparer. They might know somebody, but people who are in the tax credit game, I have not seen any hourly billing, or
I think
not much.
the biggest thing to avoid is just limit as much any upfront payment as possible, right? So you don't want to come out of pocket for an R&D tax credit that's a non-cash event or based on their estimate. You want to come out of pocket when you receive the $100,000, and then you can pay 20%. I think the lowest that I've seen is probably 15% on the R&D side as a share, but I haven't seen anything lower. We take advantage of R&D tax credits. They're great. But never come out of cash just because you're taking on incremental liability.
And please do business with a reputable company.
Yeah.
There are so many charlatans out there. There's one out there that has a whole team of attorneys just to sue the people who don't pay them their fees. That's allegations. I'm certainly not going to say who that is, but do your research on that.
That's a bummer. And then if we're developing workflows, processes, automations, et cetera, for clients, is that R&D? That, I guess, to me, I would not think so, because that's like what they're paying me to do for them.
Yeah, the distinction between it is if you're contracting, being paid to do that for the client, then there's no process of experimentation there. So that's not research, and it doesn't qualify based on that. But it's a thin line on what exactly it is. And I bring this up just because I want people to make sure that it's a strategy, right? It's something that is a potential. You're in the right industry. You're doing the right stuff for the strategy out there. It could work. You want to work with somebody who's really good, who is qualified, who does this and can document and support that with the IRS. That's
now.
I think there's another decision point, which is, do you plan to sell that software? So if I'm paying Paul to do my taxes, and simultaneously he's building a technology product to automate or optimize tax prep that he plans to distribute, monetize, and sell 1 year, 2 years down the road, then I would suspect, again, I'm not an accountant, but I'd suspect that would be fine to allocate the hours spent on that development of that tool within an R&D tax credit structure. Which is, again, just whether you plan to sell it, whether you plan to monetize it. If you're just utilizing it for clients who are then paying you for that type of work, it seems like that would fall into a little bit of a gray area / not be applicable for R&D.
And I want to add that, it's one thing for let's say ABC company hires you, the MSP, to go in there and make them more efficient and help them automate processes. That's something that they're hiring you to do, and they're expecting you to use your existing knowledge and expertise to just do that work for them. That's not research. That's just doing your job. Whereas if you are starting an MSP and you go out, you buy an RMM platform, and now you're going to start building out that RMM platform. Maybe you don't even have any clients yet, and now you've got to start writing scripts and testing those scripts to see if they're going to automate the functions appropriately. That might fall into the R&D. Would you say it does or does not, Paul?
I would work with a really skilled group of people who can qualify you. And that's
okay.
CYA, Paul. CYA. Everybody's CYA. Stay away.
Fair enough. All right. So
I'm happy to get accounting advice.
But bottom line, don't go buy a Nintendo Switch and say it's R&D. Got it.
Yeah, you have trouble with that one.
One more question. Eric heard about something called qualified small business stock at Build It Live. Does that make sense for most MSPs?
I think it's 1202. I think is what he's talking about. Yeah, that it could. That is referring to selling C corporation stock without qualified selling on a. It's like a tax capital gain free. You don't have to pay taxes on the sale of a C corporation for a qualified business, and that can make sense. There definitely is an exclusion out there. There's a lot of things. Definitely, there is an option for that. I would definitely talk with your tax person about that and see if that makes sense for you.
I think the challenge with QSBS is that it needs to be filed when you're filing the entity. So you can't really backdate QSBS, but when you create, let's say, a new MSP or a new business, and your goal ultimately is to sell the business, QSBS provides a $10 million tax credit or savings. I'm not sure exactly.
It's tax-free capital gain.
Tax-free capital gain. So if I sold my business after, and I think it's long-term capital gain. So if I started an MSP today, filed for QSBS, and then sold the business for $10 million in 4 years, I would then receive $10 million of cash proceeds and not be required to pay any tax on it.
Yeah, it's amazing. It really, but you have to structure it right.
Totally.
And I did a quick AI search. It's a special type of stock that can provide significant federal tax benefits when sold. The company must be a domestic C Corp. The gross assets must be under 50 million. At least 80% of assets must be used in qualified business activities. And then there's a bunch of other requirements for investors and whatnot, but there's a 100% tax exclusion for stock acquired after September 2010.
Yeah, huge, definitely.
Yeah, it's a big saving.
The next one I want to talk about is retirement, and this is kind of a boring one. It's on the business level. You're like, oh well, we were talking about retirement. There's all kinds of strategies out there about individuals and how these strategies you can move money around. I want to highlight these. There are 3 on this, and there's one more. It's called for military, but these are 3 here. If you have ever thought about starting a retirement plan, if you do not have a retirement plan for your company, boy, the government really wants to give you money. They really want you to start up a retirement plan. There's a big push. They know, the government knows, the people who are looking at it, and it's not political. Both sides of the aisle know that this is an issue. So they're throwing money and tax credits at people who start up. So if you start up a retirement plan specifically, I mean, if you're getting into a higher cost, if you're using your third-party administrator, your TPA, and you're spending money on that, you get a credit for starting up one. If you give money into your 401k, you get a credit for putting money into that. And if you require your employees or design a plan that they automatically enroll, you get a credit for that one. I feel like I'm at an Oprah show with this one. So I wanted to throw this one out there. Everybody gets a credit. They want retirements. This is at the business level. This is not a personal level. This is what the business can. If you have an S corporation, this will flow into your personal as a general business credit. But I just got back, really listened to somebody talk about this past week, and just wanted to communicate that this is the year. Talk to somebody about this. It's a great thing. It's good for your employees, good for retention, and it's a credit out there.
Okay, so I've got one more poll I'm going to launch real quick. This one, I don't know if it's anonymous or not. I'm not really worried about who says what. We're thinking of doing some research to determine if it makes sense for us to build a community around these office hours sessions, so that way you MSPs can talk about finance, accounting, M&A, mergers and acquisitions, Brad, and so on and so forth.
John
So
Jones.
yeah. So yeah, just let us know if that's something that would be of interest to you, and we will keep it moving. We talked about oh, good ideas for a good year. I was just about to say you talked about the retirement thing, and I see number 4 here is employ your children. Can you employ your children and um, and give them a retirement plan? Like, do you have to be eight? I never even thought about this. Do you have to be 18 to have a retirement plan? Can you be a kid with
No,
one?
you have to have or you have to have earned income. That's what they want. So yes, the answer is, here's the other thing. You can employ your kids and they pay income taxes at their rate. If you are not an S corporation, if you are a sole proprietor or in a partnership, you can employ your children as an employee and they do not have to pay payroll taxes at all. So there's this amazing. And so if you pay them $13,000 for doing work that would generate, let me qualify that it has the fair market value of the work has to be $13,000, or you have to substantiate that somehow. You can deduct that from your business. They can take the $13,000 and they could buy shoes and a car and whatever else, and they didn't pay any income taxes on it, and you were able to deduct it.
Now, do I actually have to give them the money?
Right. Is that a custodian? Who's the owner of the custodial account there? Yeah. I threw these up there. If you're taking tax advice from TikTok, I can't recommend against that, but there are a couple things on here. This Augusta rule number 6, it is legitimate. It really is legitimate that you can rent out. This comes from Augusta, Georgia, where they have the Masters, and every April people show up and they have these beautiful houses that are located next to this historic golf course. Well, people who live right next to historic golf courses know that they can make a fortune by renting this out to the golfers and the teams that come around every year. If you rent your house out for less than 15 days a year, that's tax free. So the strategy, and this is a legitimate thing. This is not on the fringe at all. But if you're primary residence and you're able to rent this out for 14 days under 15, then you get to keep that money and you don't have to pay taxes on it. So what the strategy here, and this is the end of the year, people have holiday parties, and I have talked to a number of people who their business, because it's a corporation, will rent the primary residence of the owner or management, and they will have a house party. The business pays the owner of the house for using their house, and then that is tax-free income. It's a deduction to the business, and it's tax-free income to the owner. So you'll see that on TikTok quite a bit. It is legitimate. You do have to be fair market value, and that's going to be a challenge. But it is a way to reduce business income. If for some reason you had a stock, maybe Intel or a couple other ones that had a capital loss, by taking number 3, if you just take a loss on that one, it's offsets all the other gains. That's limited to $3,000. If you don't have any other capital gains to offset it, it carries on in perpetuity. But these are a couple things. Pass-through entity tax on the state level. If make sure you're paying your pass-through entity tax, that is offsets, reduces your income on your taxable income. Talk to your tax advisor about that. Mega Roth backdoor contributions, kind of a quirky one. You have to set up as an owner of your company, you can contribute up to $69,000 into your 401k. That's the law. Mega Roth backdoor is a way of getting up to that limit. You have to talk to a third party. You have to find a TPA that will allow you to do that. But it is kind of a quirky strategy you want to work on that one. And yeah, I think that's about it. Oh, don't forget to reimburse yourself for the shareholder's home office and mileage. Just some extra expenses you probably had sitting around for the year. You forgot about that trip. And before the end of the year, cut a check to yourself put it in your bank account, expense it from your business, reduces your taxes. And it's not income, it's just a reimbursement.
Those are all great. Now, you said that we'll see the tax advice on TikTok. You know that the TikTok algorithm is smart enough to know what you're interested in. None of us are seeing tax advice on TikTok. I assure you, mine is dogs and cats being silly and people cooking delicious looking food.
Yeah,
that's my
look
TikTok.
for what an accountant is on TikTok either, Steve. Accounting is the profession that certain industries call themselves around family, so they don't have to tell people how they're making money.
Yes. Now we have just a few minutes left. I have a few questions here in the Q&A section. If anybody else has any questions, toss them in now. I want to try and rapid fire. Give us the quickest answer you can. Question number 1. We currently have a simple IRA. We are transitioning to a 401k. Will credits still apply with that as it's not startup?
Yeah, there are some that will. They asks you if you had an existing retirement plan. So one of those is disqualified if you've had one in the last 3 years. But the other ones, as far as enrolling, that is still available, and contribution, automatic enrollment and contribution will still be available. But you got to remember, a lot of these retirement plans, they're happy to take your money. And there are a couple. I have somebody I work with. I'd be happy to send somebody an email if they want to send me an email directly, make an introduction. They want assets under management. They're not charging crazy upfront fees. So these are credits for the money that you spend with the TPA. So if you find a 401k that doesn't charge a whole lot of money to set it up, which they shouldn't because they want your money, there's not a whole lot of money. There's not it's a credit to offset that. So you still get the credits on the contributions. You still get the credits on the automatic enrollment.
Gotcha.
So my answer is yes, mostly.
Brad's currently an LLC. Next year he'll be an S corp. Does he need to wait to be an S corp to get the tax credit for the retirement plans?
No. Although if you're setting it up right now, I'm not sure. It may make sense just to wait until Jan 1 if you're on the calendar year, just because you might have more expenses in that year that would count towards your credit for the entire year rather than taking just 26 days of the rest of this year, because you would use up a year of eligibility. Some of these are multiple year credits as well. They go on multiple years and you can apply for them year after year. So it's kind of this gift that keeps on giving in the tax code.
Cool. If reimbursed for the home office setup, I assume we cannot have a tax advantage on our personal returns for the home office.
If you have an S corporation, you are allowed to offset. You have the rent of your home office, and then you have the insurance and the allocable insurance and allocable taxes. That's what you can offset for that. And or you get $300. Or excuse me, up to 300 square feet at $5 per square feet. And then you just make a simple deduction. So you can take some expenses against that. So you can it's not exactly a dollar for dollar. It's not a great tax idea. It's not oh my gosh, you're going to amazing. All the rent you pay yourself is automatically, tax free. That's not the case. This is not, I want to distinguish between 5 and 6 because the Augusta rule is not your home office. So the Augusta rules are different.
Generally what I've seen on the home office side is the limitations are really, really small. And so there's just not that much of a benefit that you're actually able to expense, unfortunately.
Number 5 is really, really a lot smaller than the other ones. Some of these are bigger ideas. Some of these they're not amazing strategies. I mean, some of them are just keep this in mind. But
it's the snowball effect. You sure, one of these isn't that great, but if you're able to employ all 6 of these, the R&D thing, a couple other things, then you really start to look at a nice big savings. I almost said check, but you're not getting a check. You're just
No, you're not
writing a smaller check.
I want to address this last one before we jump because I think it's a good one. Annual tax filing cost for a $1 million revenue business is average
Oh,
CPA
man.
fees is what?
I think the best answer is it depends.
Yeah, that's
Ballpark,
overpriced.
gun to the head, ballpark.
If I here's an answer. If you go to TurboTax and you put in an S corporation, they're going to charge you $18.50 for you to do it yourself. That's what TurboTax will do on an S corp.
$18.50.
$1,850.
$1,850. That's how much Intuit charges you to do it yourself.
Wow.
Yep.
What do you charge?
Deal the deal.
I usually work on clients all year long, so it's not necessarily priced separately. Although I'm willing to talk if people want to talk to me.
Now, to clarify though, Matt said he's an LLC doing $1 million in revenue. So Matt, I think the question is, are you an LLC filing as an S corp or are you filing as an individual? Because if you're filing as an individual, then you're doing it on a Schedule C, and the price to do it on TurboTax, now you're looking at like a couple $100. And I don't know,
that.
Paul. Yeah, that's for the fancy one that they give you the audit protection and all that, right? So at that point, to have a professional do it, gosh, I mean, we're talking 10 years ago now, 5-10 years ago. I remember professionals doing it for like between 500 and 800 in my local area, but those were not people that specialized in MSPs. Those were just the local mom and pop tax people that weren't H&R Block.
The value play is really when you start running a business, the tax deductions are out there. The amount of money you spend on tax prep should pay for itself multiple times over. And it's probably on us as tax preparers to really show people where we saved them money. But yeah, you probably have somebody you're working with really well. I would just, if you are happy with them, definitely make sure you make an appointment, do some planning with them. And lastly, I would say, don't let the tax tail wag the dog. If you are looking at running your company and eventually selling it, the amount of money you make in your business, and this goes back to the last time I was on here, I made a comment about the best KPI, according to some people, the best KPI is how much money you pay in taxes. If you are running your company, you're going to pay more in taxes. If you just start throwing expenses in there to reduce your taxes, you limit as an asset on your balance, on your personal financial statement, the value of your business goes down by doing things to reduce your taxes. So, don't swap it out and be very careful about how you're doing these things, because more income through your company means a higher asset value on your company.
Yeah. And what I said, I don't know, 2 times ago, I think still rings true. There was a book, and I'm sorry, I don't remember what book it was. I keep thinking it's profit first, but it is not profit first. Anyway, so there's a book I read, and like chapter 1 blew my mind. The more you're paying in taxes, the more profitable your business is. So if your goal is to pay as little in taxes as humanly possible, or to make it look like your business has a loss so the government somehow magically gives you money, that just means your business isn't making any money, and is it a viable business at that point? So please don't feel like you have to get your tax burden down to 0, because a successful, profitable business will never be there unless you're Apple and have figured out how to offshore all of your assets to some other country somehow. With that said, it is 5:04, so we are late. Thank you so much to everyone that stuck around. And thank you, Paul. This was fantastic.
Hey, thanks for having me.
Wealth of information, and I hope all of you guys took something away from this. I hope you all sit down with your accountant and talk tax planning. If you don't have an accountant, feel free to reach out to Paul. You can go to redearthcpa.com. And we'll catch you in a couple weeks at the next office hours event. Take care, everybody.
Thank you.